All right, welcome back to the Middle Tech Podcast. You've got Logan Jones and Evan Knowles, this time joined by one of our good buddies, Michael Lewis. So Evan and I were out last week, and we missed arguably some of the biggest news in the tech industry in the past since I don't even know when. So we wanted to get back and sit down and really break down this whole SVB debacle, and we felt that there was no one better to do that with than our friend Michael Lewis, who is a finance savant, as he's been described. So Michael, thank you for joining us on here. Totally. We'll give you a proper introduction here in just a second once we get to that section. But Evan, I feel like we need to talk a little bit about that Costa Rica trip that we took, or at least why we took it. I think that's an important part of the story, why we just took off to Costa Rica.
Why did we do it other than for a vacation?
Because of the super cheap flight.
Okay. Yeah, we got $250 round trips to Costa Rica. Last year, we saw those tickets and we jumped on that. We didn't even think. Like, we were just, they hit our email and we bought them 2 minutes later.
Yeah. So that was the reason we were down there. It turned out to be an awesome trip. We road tripped around the country, saw some cloud forests, some hot springs, went surfing.
One of our friends, whitewater rafting.
Yeah, whitewater rafting. One of our friends had to get 6 stitches, which was interesting.
Oh, dang.
Yeah, Trevor.
He's all right there. He's all right there.
And I mean, it kind of sucked. You know, we were totally basically off the grid when the SVB crisis happened. Not the best time for a tech podcast to not be able to record something.
Yeah, which in some ways it's been good because we've really gotten to talk a lot about it and gain a really good understanding about it and seeing how things have kind of played out. So rather than just like talking about it as everything was coming out, which would have been great.
Well, I mean,
we're now
the All In podcast recorded their episode, and then a couple hours later, the news dropped that the government was going to secure the deposit. So their episode was out of date 2 hours after they recorded it.
So intentional. We waited for the sake of the listeners to make sure that we could give a comprehensive overview of what happened. And then also we're going to be talking about the release of Chat-GPT 4, which has been blowing the minds of Twitter users and the tech community. Multimodal now does video.
Definitely neted some like positive, exciting news to counteract the doom and gloom that has been the banking system. So that was a nice release. It was good timing.
Yeah. And then, of course, we got March Madness going on right now, which is not super tech related, but my bracket is already pretty busted up. How about you guys?
I got no expectations this year for UK basketball, unfortunately.
Same.
Well, we'll root them on either way. All right. Well, let's go ahead and get into talking about SVB. Before we do that, though, please, just a reminder to subscribe to the channel, hit that notification bell, follow us at Middle Tech Pod across all of our socials to keep up with what's going on in the regional tech ecosystem. And before we dive into this little segment, let's get a quick word from our sponsors. Middle Tech is presented by KY Innovation, the Kentucky Cabinet for Economic Development's Office of Entrepreneurship. KY Innovation is currently accepting applications for its SBIR STTR Matching Funds Program. Kentucky's program is a national trendsetter for providing critical non-dilutive capital to support the high-tech research, development, and commercialization of novel ideas within the Commonwealth. SBIR matching funds have directly contributed to the creation of more than 700 jobs, more than 200 patents filed, and more than $160 million raised in private follow-on funding into dozens of companies relocating to the state. The matching funds application window is open through April 24th. To apply and learn more about support services for companies that want to explore SBIR STTR grants and contracts, visit kyinnovation.com/SBIR. Middle Tech is sponsored by Bolt Marketing. Take your website to the next level with a website that's built to work. At Bolt Marketing, they're revolutionizing websites for small businesses that are affordable, customizable, and hassle-free. Whether you have a construction company, a boutique clothing store, or you own a hot yoga studio, they have options for you. Click the link in our show notes to explore their marketing options that can transform your marketing and grow your business. And as a personal note, Bolt Marketing built our website, and they were awesome to work with throughout the entire process. We highly recommend working with them. All right, boys. So this SVB debacle, like we said, this is probably some of the biggest news in the tech industry and in the financial markets and really just in the economy as a whole. I remember on the All In podcast, they were saying, it's like COVID, the 2008 financial crisis, and then this SVB bank failure in terms of like black swan events that have gone on recently. So I think a good place to start would be just kind of giving a high-level overview of this. So Evan, I'm going to pass it off to you to kind of kick this off. And then we're just going to try and break this down into really an understandable segment on what happened, why this happened, what this means, all that sort of stuff.
Yeah. So to back up, I think it's important to look at a few things that happened before the Silicon Valley failed. So over the past several years, the tech sector has been arguably the hottest it's ever been. A lot has been going on, whether it's really extremely high valuations on SaaS companies, Web3, AI, valuations have gone up also because of 0% interest rates. So people are looking for returns. And so this really hot period of time drove a lot of VC investment. Majority of deposits within Silicon Valley Bank or within the tech ecosystem, 50% of all venture-backed startups had money in Silicon Valley Bank, which is unbelievable to think about. So over the past several years, the amount of deposits that went flying into the bank was just through the roof. So that was kind of issue number one, was all this money went flowing into Silicon Valley Bank and they just had to do something with it. Banks have to invest that money in order to run a bank and cover their expenses and beat interest rates. And so they immediately started investing that in long-term securities, mortgage-backed securities, treasuries, 10 years of maturity on some of those. So what ended up happening was rates shot up the fastest they ever have. And they were caught kind of underwater on some of those securities, had a lot of unrealized losses. They had to do something about it because it got to a point that it was dangerous for the bank. So they had to sell some of those at a loss to improve liquidity, and they raised some money. And so when they did those two things and they brought together all of their investors, they're a public company, so they had to publicly disclose that, and they brought together their board, it really spooked Silicon Valley. And some of the top VCs in Silicon Valley messaged and emailed their founders to pull money out. So Peter Thiel was one of those. So what ended up happening at that point, the rest of Silicon Valley, again, they were highly concentrated in the startup space, way too over-concentrated in my opinion. People freaked out and there was a bank run. And so a bank run means that people don't trust the bank to give them their money when they want it. And so everybody crowds in and tries to get their money before everybody else. And about $42 billion was people tried to pull $42 billion out in just like 24 hours, which is no bank can handle that. So that was something that they just couldn't plan for. And then they got overtaken by the local, the state, federal, or was the state? The state basically took the bank over, and then the FDIC took the bank over. So that's kind of like what led up to this, the failure. And wanted to riff from there, Michael. What stood out to you the most? And then we can talk about kind of what's happened since. But of all of that, what kind of stood out to you the most? Let's dive into some of those details.
Yeah, I think it was definitely the perfect storm of events that led to this Black Swan event. For the last, since the 2008 financial crisis or a few years after that, interest rates have been low for such a long time. And just the world has been used to this very low interest rate, 0% interest rate environment where the music was playing, everybody, all equities were increasing in value, tons of money flowed into to venture funds, which flowed into startups, valuations increased, and the COVID definitely poured more fuel on that fire. And Silicon Valley Bank was absolutely perfect to capitalize on the boom of that. So all that money was flowing in, both to VCs, which is where they held a lot of their deposits, and also the companies they invested in, which held a lot of their deposits. And so, Silicon Valley Bank's deposits went from 80 billion to 180 billion very quickly. And so you talk about the industry kind of exposure. It's definitely industry risk because basically they're tied to the tech sector. I don't know if that's inherently bad so long as you're hedging the risk and you're planning ahead. I think what was incredibly surprising was just the lack of risk management and liquidity management on their part. So basically they had all this money. Like you said, you got to put it to work. You got to make money on it. So, my thought is they just thought that the music would continue. And so put a lot of money into long-dated treasuries, mortgage-backed securities, and we're just asleep at the wheel in terms of hedging the interest rate risk and also the industry risk as well. Yeah,
because on the industry risk, we understand the interest rate risk. Government, the Fed had to raise rates in order to basically slow down the economy and get us into a better state. But the industry risk there was when rates went up, startups and the funding into startups decreased, and you still had startups burning money.
Yep.
And so the amount of deposits in SVB just tanked over the last year and a half, which created, this big liquidity issue as well. So that's kind of some of the industry risk there.
Totally, yeah. The industry risk is basically, the business model of a bank is basically, I'm going to give you my money and I'm going to have trust and confidence that at any moment in time I can get that out, right? It's just the nature of banks. When you think bank, think confidence. It's all about confidence in banks. And so banks don't hold all their cash. They have to invest that to make money and earn a spread on what they pay depositors. And so totally, there's this perfect storm where, bond prices' worst nightmare is inflation, basically, and interest rates get jacked up at a very, very, very fast velocity. And so bond prices just absolutely got crushed. And so at the same time where Silicon Valley Bank's deposits were decreasing at a very fast rate, basically the value of their bonds were decreasing as well. And so I think if you really analyze the balance sheet, Silicon Valley Bank, probably would have been fine if it weren't for a bank run, right? It's not like Silicon Valley Bank just lost everybody's money and deposits went to zero, or at least the value of their investments went to zero. They probably could have weathered the storm, but it's just the bank run that absolutely just crippled it. And so, in 2008, there was kind of some similar, confidence issues. This was a little bit different too, because just this day and age, just social media and the speed of communication is so incredibly fast that within 30 hours, Silicon Valley Bank was just toast.
I think that's an important point of this. It was the fastest bank run in history. I think 48 hours is from the time this started until the time the government had to step in. And the key difference here is a bank run, back in the day, you had to physically go to the bank to get your money out. Now it's literally just clicking a button. Yeah. So it can just flood in.
Through Twitter and through communication apps and things like that.
When Peter Thiel, who is the man, who's the most connected person in Silicon Valley, says, "Hey, founders, pull your money out."
Totally.
That's going to spread.
You're going to trust
faster than
absolutely.
you think.
Totally. And so there's also a little bit of the fact that there's basically retail banks, right? So you may bank at Chase Bank or Truist or PNC, where the average individual doesn't have millions and millions and millions and millions and millions of dollars. And so the FDIC basically insures up to $250,000 of deposits. And so you have a combination of industry risk, and then you have poor liquidity management and risk management on Silicon Valley Bank's part. But at the same time, you also have mostly a commercial bank where it's not necessarily individuals that are banking. These are large corporations, meaning the FDIC insurance basically means nothing, right?
Yeah. 97% of deposits were not insured.
Not accounts, deposits, right? So, all the bank accounts had insurance up to $250,000, but $250,000 was pennies relative to the funds. So kind of the convergence of these things was okay, there was a lot of unknowns around, obviously the FDIC insurance isn't going to cover this. So it's I got to get my money out and I got to get it into where? Not another smaller regional bank, but to some kind of huge bank.
One of the big four,
where there's confidence that, that bank's going to be okay.
Yeah, and I think one of the next kind of dynamics to start discussing with this story is you started seeing, or at least from what I saw on the people I follow on Twitter, is Twitter and the public almost started breaking into two different parties. There was okay, the government needs to step in and make depositors whole, or the government needs to let this bank fail completely and the depositors are going to lose their money. Mm-hmm. And on those two sides of kind of the response to this whole crisis, the people that were saying, no, you need to make these depositors whole, that's kind of the side that I tended to side with, because the argument there was if you don't make these depositors whole, contagion is going to take hold and it's going to spread, and America is just going to lose confidence.
Yeah, the smaller banks that aren't the big four would have runs as well. So
exactly, and we still saw that contagion still happen. There are still banks that
definitely not as bad.
Not as bad.
Let's talk about what the government actually did.
Yeah, okay.
So the government did guarantee deposits, back the deposits, and then they did let the bank fail. So the investors the management and the bank got wiped out, and the FDIC took it over, and now they're looking for new ownership. I don't think they found new ownership. They did for their UK branch. UBS bought that. UBSC. I think it was UBS.
UBS.
But they haven't found an owner for Silicon Valley Bank in the United States. But they did guarantee deposits, and they let it fail. So I personally think with you that was the right approach. I don't know what you think.
I think on a net basis is probably the right approach. I mean, there's the principle of the matter is like companies understand FDIC insurance. It's not like companies were like, I mean, people understand the risk. Just the thing is, though, is like it's hard to ask individuals who put their deposits into a bank account that they have to go crack open the 10K if they're public and figure out a way to underwrite if this bank is safe or not. And so, like the tricky part here is, by and large, the depositors weren't necessarily doing anything wrong or anything, and so you had payroll has to be made. If they didn't do this, it would have been an absolute disaster, an absolute mess.
I agree.
So the principle of the matter suggests hey, rules are rules, but in practicality, like you absolutely the banking industry relies on confidence. If you lose confidence, then all hell breaks loose, basically. And so I definitely agree that the approach was probably the best of the rest. I don't think it's technically a bailout. There's a little bit of debate. Like I think that the key here is that the equity investors and the unsecured creditors of Silicon Valley Bank are absolutely wiped out. Most of the management has been fired. This isn't necessarily like 2008, where and at the same time the mechanism by which the government is providing this assistance is such that if there are any kind of losses based on the loans that are given, then basically there's going to be a special assessment on other banks, not on taxpayers, right? So I think the combination of equity investors wiped out, creditors wiped out, management's fired, depositors are made whole, and the taxpayer's not going to bear that expense is probably in a net basis.
I do want to say one other part, just because I also have seen a lot on social media from maybe people who don't understand the nature of startups and what this actually what the companies that had large deposits in this bank were using that money for. I feel like a lot of people have been saying, oh, you're bailing out big tech. I don't look at it that way. The way I look at it is if you did not make these depositors whole, then you would have seen a whole wave of layoffs because people could not have made payroll if they could not access their deposits in this bank. So the people who really bear the brunt of not being able to get those deposits out are the employees of these startups. Tens of thousands of employees that the startup is not going to be able to take on the liability of not paying payroll for these employees. The employees are going to be the ones that suffer. It's not bailing out big tech. It's ensuring that the employees of big tech are not going to get laid off, are going to be able to have payroll fulfilled. So I think that's an important dynamic when you're thinking of like, should we let the bank fail as a whole, or should we have made the depositors whole? That's, I think, one of the most important points to understand is that this is not a bailout of like millionaires and billionaires. I mean, yes, these startups are worth lots of money, but the people actually affected would have been the employees, not necessarily the
I definitely don't look at this as a bailout. I think that's a bad term to use here because it's not a bailout. Although I do think that there is a good amount of learning and responsibility on Silicon Valley's part coming out of this. They overexposed themselves. They gave themselves a single point of failure. Anytime you concentrate that amount of funds and trust into one bank as an entire ecosystem, I think that's a really fragile move on their part. They've set themselves up for something bad like this to happen. It just makes sense to hedge your risk, especially when you're somebody like a Roku or the Circle company had $3.3 billion in it, which is 9% of all of their cash and deposits. They were a stable coin. If you're one of those two companies, Roku or Circle, and you've got that percentage of your deposits in Silicon Valley Bank, and I think that's some responsibility they do bear. I mean, that's hundreds of millions of dollars and billions of dollars, and you've got it in one bank. It's your responsibility to go to that board and say, you need to make sure that my underwriting and my risk assessment team has the data we need because so much of my money is in here. And that's across the board of Silicon Valley. And I think that after this event, they're going to make themselves more anti-fragile and start to spread out their deposits. Mm-hmm. And they're going to figure out how to not set up points of failure like this because this was a really big deal. And I think it comes back to Silicon Valley's mindset. And it's kind of an inward-looking boys club's not the right word because there's plenty of females out there, but it's kind of like just this.
Maybe.
It's very incestual. It's a bubble, and I've been out there several times, and every time I come back, I'm like, man, it's unbelievable how big of a bubble this is. Not bubble in the terms of it's gonna pop, but it's like you're living inside of an echo chamber is a better word here. And to your point, the music was going, and they expected to go forever, and I think they just traded on relationships and feelings more than they did data, and they didn't underwrite and manage risk. And that this is an outcome of that. And I think Silicon Valley needs to look inward and prevent this from happening again. And I think with remote work, and I think with some of the things that have happened in the economy and COVID over the last several years, you've seen tech companies move out of Silicon Valley. I think that's very healthy for the overall ecosystem, not to have such a concentration in one place, because I think Silicon Valley Bank is a embodiment of both a mindset, but also a concentration of talent and resources in a small area. And whenever you have that kind of concentration of anything, it's going to pop. It's guaranteed. It's impossible not to. I think it's nature.
Sure. Yeah, and it's also worth noting that Silicon Valley Bank is north of just collecting deposits and making loans. There's also an investment banking arm, private wealth management arm, venture
debt.
Yeah, massive amounts of venture debt. I think they own warrants in just thousands and thousands of companies. And so, the exposure was with north of just, hey, here's my cash. I definitely think after this, and rightly so, like the Rokus of the world, very large, publicly traded, hundreds of millions of dollars of cash. That's just dumb if you just keep so much of your money exposed to one bank.
Probably a relationship. There was probably a relationship there where Roku had a relationship with that bank, and they were helping each other out.
Yeah. But yeah, there's simple things you can do to spread that risk. I do think a lot of the account holders, though, were a little bit more Series C, Series A type companies who, hey, here's $1 million, and it's not even on the radar to think about how can I manage my deposit
Nor
risk.
should it be.
Say, hey, I need to go figure out a way to scale this company. I'm not even care about this. And so for sure, some of the larger companies, they know better. But even now for smaller companies, it's just too easy not to open multiple bank accounts at multiple different companies. So, and
a lot of products are going to come out of this too. You're going to see the fintech space build products that distribute funds through several banks, through sweep accounts. There's going to be all kinds of ways for a founder to not put their money directly in a deposit account, but rather put in a money market account and be able to see that money in their fintech user interface and be able to control where that money flows and spread it out. So a lot of new great products will come to prevent this from happening in the future.
I think so. I think it will also, one of the big side effects is going to be the big banks are going to keep getting bigger.
Yeah, that's what I was about to say.
Because even those fintech tools will probably be built on top of a JP Morgan or some kind of Citibank or something. And so just basically again, it's all about confidence. And the big banks are held to a different set of rules, to higher standard, which sometimes is a bad thing, but in this case is a very good thing. So I think the government also needs to take a look at banks that have $250 billion or less in deposits and change the accounting rules, implement some new regulation, because next thing you know, these big banks are just going to keep getting bigger, and regional banks are great for local economies,
for underwriting special cases.
Yeah.
There's all kinds of things local and regional banks do that help the economy.
Yeah, you don't want a super centralized banking system, and I think one of the things to discuss here as we kind of look forward and think about how does this play out over the next few months and then over the next few years. With this FDIC insurance only being up to $250K, basically what's happened is they've said, okay, well, that's not the case. We're willing to insure all deposits. So at this point, is the FDIC going to come out and say all deposits, no matter what, are insured? Or because what I was hearing on one of these podcasts that I was listening to, trying to do research and understand all of this, is if you even have a 1% chance of losing your deposit if you put your money in a smaller bank, then why would you not just go ahead and go into one of the larger banks?
Right.
And I think that is what regulators are going to have to be thinking about, is we need to make sure that we can protect and preserve these regional smaller banks, because they play such a vital role. Take Lexington, for example, or Kentucky, for example. The banks that are helping grow the economies in these regions is it's not the JP Morgans that are giving the loans for developments in this region. It's the regional banks. And I think that that's really what needs to be paid attention to next is how can we make sure that we're protecting that class of banks?
I do think that, FDIC insurance does need to be looked at, and there'll be changes there, I'm sure. But I also don't think that every bank needs to be guaranteed and all deposits needs to be guaranteed. I do think there's a factor of let the market do its thing, because if you do back every bank and make sure all deposits are taken care of, you don't let the market take care of itself. Some banks might need to fail. Some deposits might need to disappear in order to get the market to wake up and adjust. And if you don't let that happen, then you just allow potentially bad behavior and bad actors to take advantage of the system because they know they're guaranteed. So there's an element here that's somewhere in the middle where some banks should fail and it might be painful, but in the long term, it's going to create more anti-fragility for the whole thing.
I think if you look, I think the stat is from either 2000 or 2003 to today, 500 banks have failed basically in the last 20 or so years. So like the concept of banks failing is not, it happens all the time, right? And generally it sounds kind of rough to say, but generally it's a good thing, right? If banks are taking, bad risks or not, treating their customers well, then they're going to fail. But there is this kind of inherent non-written agreement that, hey, there is such thing as a too big to fail institution. And so, if you have $1 million and you want to make sure it's going to be there tomorrow, then
I've got stats
why not get the big?
We've been through worse as a country as far as bank failures go. So as you mentioned, from 2009 to 2023, we've had 512 bank failures. From 2009, it looks like until 2014, probably 95% of those took place. And then starting 2015, 2013, there were about 20 bank failures out of those 512. So over the last several years, we've been in a good spot, but the economy's been in a good spot. So there's been bank failures. So I don't think we should prevent banks from failing and deposits from disappearing because it's already happened throughout our history, and it's happened a lot since 2009. But we're probably going to see more failures. And I don't think we should keep everybody whole and protect all deposits. I just think we got to create more regulation and let the market do its thing. We just got to prevent it from getting out of control while letting the market feel some pain. But in this case with Silicon Valley Bank, I do think this was too big of a failure. It would have created contagion if they didn't guarantee these deposits because it happened so fast. But going forward, I do think we got to let the market do its thing.
Totally. So I think maybe this is the point we can end on as we kind of think into the future from here. One of the questions that I've had, and I know, Evan, you and I talked about this a little bit, is what effect is this going to have on the Fed raising rates into like the next several months, year, whatever. We've been raising rates really quickly to try and combat inflation. That's showing up in all throughout the economy right now. Is this going to have an effect, or is Jerome going to look at this and say, okay, we were raising it until something breaks, something broke, something pretty big broke. Are we gonna pull back raising rates to make sure that the system is a little bit more stable before we continue doing that? And it seems like it's going to be a big balancing act because, of course, on one hand, you want to slow down the economy and make sure that inflation gets under control. On the other hand, and this is probably the biggest part that I had to really grasp is like what happened was, Silicon Valley Bank needed a return, so they invested in those low return bonds. Then rates went up. Their bond value basically went to zero. They had to, liquidate a lot of those bonds to get the money they needed. So are we going to start slowing down raising interest rates? I don't know if you guys have thoughts on that, if there even is an answer to that. So maybe it's more opinion-based.
The Fed's in a tough spot. Do we protect banks or do we hedge inflation and stop inflation? I don't know.
I'm glad I'm not Jerome.
What you think. Yeah.
There's definitely a balancing act. Really, I think it's about like if next week if they don't raise rates, it's like, okay, maybe the Fed sees something and we need to be worried. And then more fear sets in and some more confidence issues. But if you raise rates too fast, it's like, hey, we just had a huge, stress test here. Slow your roll.
More of them will probably happen.
But inflation's still pretty high, so we got to get inflation down. So I'm glad I'm not Jerome Powell. That's for sure.
All right. Any final points or thoughts that either of you guys would like to share before wrapping up this segment?
No, I will say it's kind of a lighter note. I think Jason Calacanis is a complete idiot. I do not like how he handled
all caps.
I do not
Caps
like
button
how
broke on
he
Twitter.
handled any of this. Fellow podcaster, way bigger obviously than us. He's got All In podcast, but there's just some mindset. There's just a lot of noise. I think there's just an entitlement in Silicon Valley, and I think he's an embodiment of it. And I think this whole crisis, he did not approach it the right way, and I think that he's an embodiment of what I think is in a lot of ways wrong with Silicon Valley and needs to be fixed.
Agreed.
That's just one thing I noticed as I watched this. I was watching a lot of people on Twitter and how they were reacting, and a lot of reputations I think people looked at differently now.
I think one final theme that I'll hit on that I think can be taken away from this, and this is broader than just like finance and the economy and everything, and that is, we hit on it already, but just the speed that this happened due to social media and the spreading of like fear, uncertainty, and doubt.
Yeah.
We need to really pay attention to that in this age of social media, because we have access to information instantaneously. Lots of people are probably not fact checking the information they're getting from social media. So it's like, do you know if it's disinformation? Do you know if it's accurate? What are the sources? Where is it coming from? And then you see real world consequences happen because of that. Mm-hmm. I mean, it could be name XYZ disaster event, whatever. I think that's something that
I've actually been thinking a lot about this because if there is a hacker group or a terrorist or another state that watched what just happened and they said, oh, we can use information to cause bank runs, now is a prime opportunity for the United States to be attacked. Isn't it a prime opportunity to attack the United States? Sure. Via social media and information and misinformation.
Psychological warfare.
If they wanted to right now, we're very vulnerable. I mean, you want to cause some fear in the banking system, everybody cause a bank run via Twitter and Facebook and TikTok. Somebody could potentially do that right now.
They could, but like honestly, the whole world, I don't know. They could do it, but like, good luck being protected from it, because the global financial, we're the global financial superpower. Yeah. So if we go down, then everybody else is going to have some trouble too. But
there'd be a war before we go down. All of our military's prime spot here. We're off the rails.
All right, yeah. We'll cap it there. Michael, I meant to do a better introduction for you before we actually got started. So let's take a second to, you've been on the podcast before.
Let him introduce himself.
Yeah, thank you. That's where I was going. Appreciate you butting in there. Michael, tell us about your background, what you're into, just real briefly here, so listeners know who you are. Yeah,
for sure. Been on the podcast before, so thanks for having me again. My name's Michael. Live here in Lexington. Co-founder of THESIS Education. So our kind of main company is called Business U. We basically develop curriculum and software that we sell to high schools around the nation that teaches kind of all things marketing, finance, accounting, entrepreneurship to high school students. So really our mission is to partner with teachers to inspire students to pursue careers in entrepreneurship and business and understand how business is all around them. So that's what we are doing every day. And then kind of THESIS is that collection of our people, our process, our platform that our goal is to leverage to solve different solutions in the career and technical education space. So
perfect. And you also have quite the background in finance. You served as fractional CFO for a couple companies. Yeah, my background is really finance and accounting. A little bit more focus on kind of venture finance, working with some different startup companies in a fractional CFO capacity. Evan, myself, and some others do some real estate investing together. And always super fascinated about what's going on with the financial markets and world of business, and always reading quite a bit about it. Yeah. Well, you're the perfect guest to supplement this discussion and talk about all this chaos that's gone on in the financial markets lately. So thank you for taking the time to come on. Yeah, thanks for having me. All right. For our next section of this podcast, we're going to get into our AI Edge segment. So because we hadn't had a chance to do one of these podcasts in the past 2 weeks, there's just been two really big stories. So this podcast is going to consist of the SVB stuff as well as the release of GPT-4. So this AI Edge segment is just going to be all about GPT-4's capabilities, what's been going on with it that we've seen on Twitter and in the news and in the media. So Evan, I'll let you kick it off. Tell us a little bit about Chat-GPT-4, what you've been doing with it. I'll share my screen. We'll walk through the interface and dive into another huge jump and iteration in OpenAI.
Yeah, so I haven't necessarily been using it much differently. I haven't figured out, how to test it yet. Many people on Twitter are, though, and have created some really cool tests. The big thing to know is that it's just a much, much more powerful model. There's a lot more parameters in this than the previous models, so it has a lot more power to reason, to basically infer certain things from, for instance, if you're given a paragraph and ask it to analyze it, it's way more intelligent. It's way faster than some of the previous models. We can show you how we can throttle that. Some of the previous models are faster, so they optimize different things, but this one's both more powerful at reasoning, conscientiousness, and it's just got way more parameters. So let's dive into, and you can share your screen on what it actually looks like. I think this is important for the audience to see that maybe hasn't tried Chat-GPT yet, what this looks like and how to interface with it. So we'll walk you through it. Are you sharing your screen?
Yeah, sharing my screen. I think something else to note at the front here is that they are paywalling GPT-4, so you have to have Chat-GPT Plus, which is $20 a month, so kind of expensive. But that's just something to say at the front. Just to be aware.
I mean, if you're a business and you create content, or if you're an executive or a manager and you are responsible for a lot of things, and there are a lot of things on your plate, this is, in my opinion, a no-brainer. So let's walk through it and show people what it actually looks like.
Yep. All right. So we're on the user interface here. Do you want me to enter in this prompt here first, and then we'll kind of walk through how to change from different models?
Yeah.
So just like what you're used to before with Chat-GPT, we're just going to kind of show how much quicker it is, how you can change from model to model, and then just talk about some of the nuances, especially it being multimodal, which I think is probably the thing I'm most excited about and what I think is the biggest leap as part of this change. So as Evan was kind of mentioning throughout all of those, less biases, model size is way bigger, multimodal. But Evan, talk through kind of the nuances around being able to switch between models, and let's linger on that point a little bit, because I think that kind of goes along with some of the larger discussions we've been having about the future of AI, being able to choose what kind of model you actually want to interface with, and let's kind of relate that to how they're building that into this interface right now.
Yeah. So you can see we asked it, what's the difference between you and previous models? And so it's given us a list here. This is straight from the source of Chat-GPT, and this is the GPT model. So you can see its model size is larger. The training data is more diversified, so it has more knowledge about different topics, different data sets. Capabilities, you can see that it has increased capabilities to compare to its predecessors. Its understanding of context, handling longer conversations, maintaining consistency, providing more accurate information. It's better at these things. It's also better at things like translation, summarization, question answering, and generating creative content. So it's really improved across the board with its capabilities. And then fine-tuning and safety, I think, is an important one. OpenAI has been under hot water related to biases. You can ask it certain questions and it answers them differently depending on political bias, which is kind of scary. So we don't want that. So they've been fine-tuning that and trying to get that out of the system. So really the big thing here that I think is most important, that's just much more powerful, a lot more parameters, a lot more capabilities, and people are applying other models to it. So to your point, making it multimodal, you're able to, for instance, feed it a picture of, let's say, a refrigerator and all of your stuff you've got in a refrigerator, and ask it to generate a recipe.
Yeah, that's crazy.
So it's stuff like that amazing capabilities are being shown. So that's what we got going on here. Jump out of, on the left, create a new chat, and go up to the top, and you can see where you can choose the models. And this is where I was talking about you can compare their strengths. So the default is the last model. You can see that, reasoning, it prioritizes speed. So if you're not necessarily needing a lot of capability and just need a quick answer, you can go to that. Legacy, this is the previous Chat-GPT Plus model. So you can see that capability, and then go down to Chat-GPT-4, way more advanced in reasoning, conscientiousness. Conciseness.
Man, let's take you back to first grade.
Can't read over here. I actually did really struggle reading. I couldn't finish the ACT. Let's go into that rabbit hole. Okay. Speed. This is a faster model than some of the others. So yeah, this is what Chat-GPT looks like. I think that everybody should at least try the free version, but this is what Plus looks like. And I have a hunch that as OpenAI develops more models and there are companies that create niche models, I think one day you'll be able to hit this drop down and select a lawyer, select a doctor, select a tax accountant. You'll be able to select really niche models and select kind of what you're looking for to help you get to that data faster. I think that's what's going to end up happening.
Yeah, I think that's really essential. We kind of had this conversation when we were traveling, talking about how right now we're used to looking for an answer on the internet. We go to a search engine, we're presented with like a ranked list of options that we can click on and kind of do our own research. Whereas with AI, you go and ask it a question, you get one single answer. And as you were saying, that's going to be a pretty big shift in how we seek out information and how we mentally process the information that we're getting, how we, hold the validity of that in our own minds. And I think it is important to be able to fine tune how you interface with AI and what kind of model you're interfacing with. So I think you're spot on when you're saying, you want to be able to have the option to know what kind of AI model you're interfacing with and be able to tweak the parameters on that.
Yeah, having a general model is dangerous. Yeah. While it might be efficient, I think that people still need to be given the choice to choose their model because there will be proprietary data within certain models, but more importantly, general artificial intelligence when that day comes, when that narrows our options and we just get one answer, I think that's really dangerous for humanity. And I think we just need to know, hey, which model am I looking at?
For sure. Anything else you want to hit on about GPT-4? Anything there before talking about kind of the tip of the week, the tweet that you're referencing?
Yeah, I don't think so.
All right. So you sent me a tweet. It talks about basically being able to get expert advice from AI. So dive into that, give an overview of what it is and how you would do that.
Yeah. So for instance, with the new model of GPT-4 is even better at this. You can tell it to talk to you as if it is somebody like Steve Jobs. So it knows everything Steve Jobs put on the internet. It knows everything he ever wrote. It knows his tone. So if you say, hey, Chat-GPT, you are Steve Jobs, talk to me as if you are. I'm going to ask you questions and then you answer them as if you're Steve Jobs. It'll do it. And so if you've got somebody you look up to and you want to talk to them, and they might be dead, they might be alive, you can have a conversation with them via Chat-GPT, which I think is scary for that person. But it's cool for you as a user to maybe interface with somebody that you look up to and want to learn from.
Yeah, for sure. I think it's a great tip. One of the last things I'll kind of say about GPT-4 and this, I've said it multiple times, it really does feel like this field of AI is just advancing at breakneck speeds, and it's literally hard to keep up with. It's going so fast. But the other side of this and what that kind of means in terms of the current technologies that we have access to is so now ChatGPT's API was made available 2 weeks ago?
Yeah.
So now all sorts of programs are being built on top of that. As soon as they update the model and release a more powerful model like GPT-4, immediately all of these companies that are building on top of that API are going to be able to have access to this new model. So it's not only is ChatGPT and OpenAI itself advancing really, really quickly, but they're pulling along every company that's building on top of their API along with them. And I think that's just something that is going to produce speed of innovation that we're just not ready for. I think we're already seeing that we're not ready for the speed of innovation with just how quickly it's going. I feel like unless you were just really interested in technology before, it's probably almost impossible to keep up with everything that's going on unless you listen to this podcast consistently or follow a bunch of people on Twitter that talk about it a lot. But yeah, that should wrap up our AI Edge segment. Anything else you want to add before?
Nope. I'm just over here talking to Elon Musk.
Of course you are. What are you talking to him about?
I just asked him, what's the number one tip for entrepreneurs? What are first principles? The funny thing is I told it, hey, you're Elon Musk now, so answer my questions as if you're him. It said, of course, I'm happy to answer your questions as if I were Elon Musk. Keep in mind, though, I am actually an AI model and not Elon Musk himself. Go ahead and ask your questions.
That's important. So don't want to forget that.
It's crazy.
All right. That'll do it for the AI Edge segment and for this episode. I do want to take just a second at the end of this episode to just catch everyone up on kind of what we're thinking on, what we're working on middle tech wise. We met the other day. So if you tuned in last week, you saw that we released kind of a more traditional episode to us, which was just catching up with a founder, Synaptech, Kate Van Pelt. Sat down with her and just got the latest on what was going on with her company. So I just want to kind of lay out where we plan on putting more focus over the next few months. We definitely want to get into more founder-focused interviews. So we're always going to continue to do these types of episodes, but kind of as I see our role in this ecosystem evolve, I want to keep everyone informed with kind of the latest on what's going on in technology. But something that I'm excited about is, at this point, we've probably interviewed 80 to 90% of the founders that are building companies in this region that we kind of cover. And now I think what I'm excited to do is continue to keep tabs on what's going on in this ecosystem. So whether people have raised funding, whether they're looking to raise funding, whether they have grown their team, have introduced new products, have done a pivot, we want to start talking to founders and just checking back in with people that we've already had on the podcast previously. So that's kind of what you guys can expect from us over the next few months. I'm really excited about that. Don't know if you have any thoughts you want to add to that, but just wanted to get that out there on the podcast so that people know what to expect over the next little bit.
Yeah, I mean, I echo all that. I think highlighting founders is really important for everybody to learn about what's going on and who to look up to and who to learn from.
For sure. Thanks for tuning in, guys. We'll see you next week.